Your crypto gains just got wiped by oil prices. Brent jumped 12% above last week's low because Trump killed a deal with Iran. Wednesday, August 12, 2026. Like and subscribe for daily market updates. Today's agenda, the market snapshot. Trump kills the deal. Bitcoin below $64,000 support. Up next, Trump kills the deal. Let's look at the numbers before we panic. Bitcoin is trading right here at $63,659.19. That is a small gain of 0.18%, but it feels like progress while everyone else sells. Ethereum did better today. It climbed to $1,887.54 with a positive 3.34% move. Now, look at the stocks. The S&P 500 is down by negative 0.32%, sitting at 7,728 points. That feels like noise compared to what happened in energy. Oil prices are up big time. Brent crude hit $89.55 for a gain of 0.72%. Gold kept climbing too. It is now at $4,467.40, adding 5.59% to the week's total. The dollar index barely moved up by 0.04%, while yields dropped slightly from yesterday's peak near 4.68%. Why does this mix matter? You hold Bitcoin, but you also own a house with a mortgage or maybe some bonds in your portfolio. When oil spikes, inflation worries return, and the Fed might not cut rates soon enough to help everyone. That is why gold rises, while stocks struggle right now. That oil spike is dragging down the broader stock market index now. Peace hopes evaporated instantly this morning, after President Trump demanded 50 years of compensation from Iran as a condition for reopening the Strait of Hormuz. This is not merely a diplomatic dispute. It fundamentally alters energy price calculations. When that proposal failed, traders reacted immediately, pushing oil prices higher than last week's lows by more than 12%. Brent crude surged past $89 per barrel, while West Texas Intermediate climbed toward $84 as well. You might ask why this matters for your wallet right now. If Iran does not pay the required compensation within 50 years, a long time frame, but one still possible under pressure, the threat of conflict returns to global markets immediately. This scenario guarantees unpredictable price swings in energy stocks and eventually drives up costs at the pump. The market abhors uncertainty, particularly regarding oil supply disruptions near Hormuz. Consequently, traders are currently pricing this specific risk into asset values because Trump's demand effectively killed the plan overnight. The financial implications extend beyond simple headlines. They represent a tangible shift in global economic stability that investors must monitor closely. As geopolitical tensions rise over such demands, volatility increases across all major energy sectors worldwide. Investors need to understand how these diplomatic shifts directly impact their portfolios and daily spending habits on fuel. The potential for sudden price spikes remains high if negotiations stall or collapse entirely under the weight of these stringent conditions. Market participants are watching every development with intense scrutiny, since any news regarding Iran's willingness to pay could trigger rapid reactions in trading floors globally. Even a small delay in reaching an agreement can cause significant fluctuations that ripple through supply chains and consumer prices alike. This situation highlights how closely linked political decisions remain with economic outcomes for ordinary people everywhere who rely on stable energy supplies for transportation, heating, and manufacturing processes essential to modern life today. Gold is doing something different while stocks and crypto struggle today. One single data release today dictates whether Bitcoin secures its future trajectory or faces deeper correction. The Consumer Price Index report arriving at 8:30 a.m. Eastern Time. The leading cryptocurrency is currently trading beneath the critical $64,000 threshold after failing to reclaim the psychological barrier of $65,000 for 4 consecutive sessions. This decline has pushed price action into an immediate test of support near $63,650, a level that historically acts as a rate change point between accumulation and distribution zones. A surprisingly cool inflation data print could trigger a technical rebound toward previous highs by alleviating fears of prolonged monetary raising interest rates. Conversely, elevated inflation figures would likely shatter the floor, forcing sellers to push prices lower in search of new available cash in the market. The stakes are exceptionally high, because Bitcoin functions as a premier risk asset within global portfolios. When inflation data spikes, institutional investors grow anxious that central banks will maintain restrictive policy stances longer than anticipated, draining capital from speculative assets like crypto into safer havens. This dynamic is currently exacerbated by the yield curve remaining stubbornly anchored near 4.68%, signaling that market participants believe the Federal Reserve cannot raise rates quickly enough to curb inflationary pressures driven specifically by surging oil prices and supply chain disruptions. If you hold digital assets today, your unrealized gains are being systematically eroded not just by technical weakness, but by big-picture economic challenges pulling Bitcoin below $64,000 as capital flees toward bonds or gold seeking stability against a potentially sticky inflation environment that could persist well into the second quarter of this year. That brings us to inflation data today matters most. Gold surged 5.59% today as Bitcoin stagnated and stocks fell, signaling a sharp shift in market investor mood regarding purchasing power parity. This unexpected divergence shows investors recalibrating their inflation models immediately. Rising oil prices near $90 per barrel fuel fears that the Federal Reserve cannot cut rates fast enough to curb global energy spikes. Small businesses face mounting debt service pressure as these costs rise worldwide. The scenario mirrors 1974 stagflation, where soaring commodities paralyzed central banks. History suggests real yields will compress further without aggressive rate cuts, eroding fixed-income portfolios and driving capital toward tangible assets. Gold must give back half its move by Friday, unless the Fed signals dovishness in minutes released later today, a surprise given high oil prices with no relief yet visible. The mechanism is clear. Sticky borrowing costs force investors to flee nominal currencies for hard assets offering zero counterparty risk, while preserving value against debasement. Why gold rises? It serves as a wealth sanctuary when rates hover near 4.68% and inflation fears return due to global tensions over Iran. These global political frictions threaten supply chains, specifically oil and shipping lanes, potentially spiking energy costs before the Fed reacts. For investors, this environment demands an overweight position in non-correlated assets like precious metals, while reducing exposure to duration-heavy bonds that suffer when inflation expectations remain anchored higher than anticipated. The dollar index is quiet, but it tells us something about global cash flow today. At 8:30 a.m. Eastern Time, you see a July Consumer Price Index report drop down with heavy weight for global cash in the market. Bitcoin struggles below $64,000 after failing to defend its critical support of $65,400 for 4 consecutive days. This signals fragile investor mood sensitive to big-picture economic data. A cooler-than-expected inflation print could ignite an immediate price bounce by confirming the Federal Reserve's rate change toward rate cuts. Unlocking capital happens fast for stocks and crypto before Friday closes. Conversely, a hot headline number reignites fears of prolonged high rates or surprise hikes from officials. These fears potentially shatter support levels unless bond yields drop further tomorrow morning to offset pressure. However, global political tensions in Russia drive an oil price surge that keeps energy costs elevated regardless of inflation data figures today. You watch as this creates divergence where consumer prices may appear stable, while underlying cost-push inflation persists through higher fuel and logistics expenses. Historically, markets ignore initial data until second-order effects materialize. Traders remember how supply chain bottlenecks masked true pressure in 2021. Rising oil costs could force the Fed to keep policy restrictive longer than anticipated by anyone watching closely. For investors holding small businesses with imminent debt service payments, this dynamic is critical for your strategy. If yields remain stubbornly high, despite a good inflation data report, borrowing costs will crush cash flow for leveraged entities worldwide. Do you think risk assets can truly recover or face further downside before Friday's close changes everything globally? Therefore, traders must watch not just the headline number, but also oil futures and bond yield curves tomorrow morning to gauge reality. Finally, let's turn to what to watch next. The S&P 500 posts back-to-back losses before Friday closes out unless yields drop further tomorrow morning. A severe tech sell-off weighs on you today as uncertainty surrounds Iran right now. This isn't merely emotional. It reflects a tangible shift in risk appetite, where investors are rapidly rotating capital from high-beta growth stocks into defensive sectors. Global political tensions threaten supply chains, so watch the Dow end over 180 points lower. Alphabet stock sinks along with other big tech names losing value in this session. These giants face immediate margin pressure if conflict disrupts semiconductor logistics or data center energy supplies. Meanwhile, gold settles at a 2-month high because investors want a safe place to store wealth, while oil prices climb toward $90. Inflation fears return due to Trump's demands on Iran. Higher crude costs directly feed into core inflation data components, like transportation and heating bills. This forces the Federal Reserve to keep rates restrictive longer than markets anticipated. Do you know what happens next week when inflation data lands again? Or will talks move regarding Hormuz reopening soon enough for peace hopes to revive globally speaking across borders worldwide, including small businesses struggling with debt service payments, monthly due dates approaching quickly soon? A breach in the Strait of Hormuz would spike energy costs instantly, potentially triggering a stagflationary spiral that erodes real wages and crushes corporate earnings forecasts. For investors, this environment demands a rate change toward quality dividends and hard assets rather than chasing yield through leveraged tech names vulnerable to global political shocks. Oil prices surged 12% after President Trump ended negotiations with Iran, creating immediate threats for drivers and energy investors, before Friday's close unless yields decline tomorrow morning. Bitcoin slipped below $64,000 as macroeconomic concerns weighed on the market. Meanwhile, gold rallied 5.59% to a 2-month high, offering a safe haven against rising inflation fears driven by escalating geopolitical tensions in oil markets globally. Investors are increasingly fleeing stocks for precious metals, while small businesses face approaching debt service payments amidst these volatile economic conditions worldwide. Thanks for watching Market Pulse Daily.